Hi Andy, this is Fritz Meyer. I wanted to do this blog posting and video posting today because day before yesterday the President made this comment that the private sector is doing fine. And as we're all aware, that comment really provoked a firestorm in the media. And I've been watching. It's actually very interesting to watch the reaction to that comment on all of the various, both financial media and more political media like Fox News and CNN and so forth. But I wanted to put numbers to the data that the President was talking about just to bring some clarification to the whole issue, because I think probably it's very easy to perhaps accept what one side or the other side is saying blindly, and I think it always helps to, in fact, look at the data and then be able to come to a more informed judgment as to whether he's accurate or he's not accurate in a statement like that. So I'm going to start with a slide entitled "Employment Post-Recession New Job Formation is Choppy." I think one very important reason for the rather tumultuous reaction to the President's statement was how horrible the most recent jobs number was. Horrible, and there I'm characterizing the number pursuant to what I've been hearing in the media. In other words, 69,000 net new jobs created in the month of May was described by most in the media as a pretty terrible number. So I'm starting with this slide simply to illustrate the fact that, yes, it was a weaker than expected number. However, the pattern that we're seeing traced out in the new job formation data series, as you see in this chart, is really pretty normal, pretty typical. And while 69,000 was lots less than 100,000 expected, nonetheless, it's still higher than last year's trough. And as I said, you have to expect lots of volatility in the month-to-month net new jobs created statistic. And furthermore, as you can see in this slide, to the extent this turns out to be a summer slump in new job creation, it would be very much like last summer's experience. So I think that's very important, because so much about this summer's economy resembles last summer's economy. The two key concerns, for example, in the stock market and with respect to the economy are, number one, renewed concerns over Europe, and number two, a new slump in job formation, which turned out last year to be very much a seasonal development, which was followed by, in the fall and winter months, very strong net new job formation, as you see in this chart. Now, moving a step forward, you see in this slide net 69,000 new jobs created on the so-called establishment survey in the month of May. But interestingly and tantalizing, at least in my mind, is the fact that at the same time the Bureau of Labor Statistics did the establishment survey in the month of May, they also do the monthly household survey. And on that survey, lo and behold, you see a net 422,000 new jobs created in the month of May. And again, the caveat here is how volatile that data series also is from month to month, and it's actually a lot more volatile than the establishment survey. Establishment survey, by the way, is the Bureau of Labor Statistics survey of large employers, whereas the household survey is a phone survey of something like 60,000 households every month. And in that survey, you're picking up part-time jobs, you're picking up sole proprietors, and you're picking up agricultural jobs, which you're not picking up in the establishment survey. So it's a different look at the total employment picture, but nonetheless, on this basis, it's very encouraging. And also, if you were simply to put a ruler and try to trace out a trend of the red line, for example, one would see higher lows and higher highs, suggesting positive upward sloping data series on the household survey, and not so much on the establishment survey. So I thought that is a relevant statistic in the context, again, of the total jobs picture. And as I was saying, I think the firestorm in the media over the President's comment was principally because it's on top of what was considered to be some very negative or increasingly negative news, foremost among which was the May jobs number. Okay, now let's dissect, let's look behind that headline, total 69,000 net new jobs created in May. And what you see here is that there were 82,000 net new jobs created in the private sector, offset by a 13,000 takeaway in the government sector, resulting in a net 69,000. So when the President said the private sector is doing fine, in part he could have been thinking about these numbers. In other words, the private sector, particularly compared to the public sector, the private sector has been, in fact, doing lots better than the public sector in net new job formation. And again, if you were simply to draw a line through this data series, the red line here, the private sector net new jobs formed, you would see that you could conclude that we have been creating now for almost 2 years new jobs at an annual run rate of something like, not an annual, a monthly run rate of something a little less than 200,000. I simply do that by running a line, which I think is a legitimate observation there. So again, that's one reason the President made the comment that he was making, because by comparison to the net new jobs created in the public sector, private sector net new job formation has been pretty good. Now here's another look at the private sector net job formation. First of all, data that comes from ADP's monthly survey compared to data that comes from the Bureau of Labor Statistics. And so in this chart, what you see is ADP actually is showing a more favorable net new private sector job formation trend than the government's data. And the reason I say that is, again, if you were simply to draw a trend line through the red data series here, which is the ADP monthly private sector net new job formation statistic, it looks like, again, higher lows, higher highs, an upward trending slope, whereas the black line is more of a flat trending net new job formation data series from the Bureau of Labor Statistics. So again, that is reasonably encouraging, and it's another reason perhaps for the President having said what he said. Now let's look at total the big picture on the total jobs recovery data. Here we are back to, as you can see, 133 million total employed in the U.S. economy. One key question is, well, how does this recovery compare to previous recoveries in the rate of new jobs created? In other words, the recovery slope of this jobs recovery compared to the previous recovery. And here, what you can see is, indeed, this is a more sluggish jobs recovery than we saw last time around. And you can see the comparative slopes for the last recovery in jobs compared to this one. Secondly, a key statistic that you often hear referred to is that we are back to 133 million total jobs in the economy, but that's still 5 million short of the 2008 total 138 million jobs peak. And because we keep adding to the labor force by virtue of continued population expansion, well then the unemployment rate has a really hard time coming down if you're not creating new jobs at a lot faster clip than what we've been doing currently. And I think this is probably a reason the President caught a lot of flack for that comment that he made. This by no means looks like the jobs recovery is doing pretty good or something to that effect. In other words, he said the private sector is doing fine. Well, it's clearly not the case that this jobs recovery is doing fine. It's doing a lot less than it has done in previous recoveries. Now, let's look at breaking down that total jobs number. In other words, total jobs of 133 million, most recently measured, breaks down into the public sector versus the private sector. And again, the President's comment was the private sector's doing fine. Well, let's look at this recovery in private sector jobs, and the recovery slope there is 1.7% compared to the recovery slope in the previous recovery of 1.79%. Well, in fact, his statement rings pretty true in this regard. In other words, the rate of recovery in private sector jobs isn't too far off of the rate of recovery in the last in the last jobs recovery. And the big problem here, as the President pointed out, is that we're still in net contraction in government jobs. So I think this is a key chart in understanding the dynamics of this jobs recovery. Government sector clearly is the drag on total net new jobs created. Private sector is in fact doing pretty well, not as well as we've seen in previous recoveries. Well, let's look behind these government jobs, because again, what I'm going to show is also an illustration, or at least can by way of explanation of what the President was talking about. Let's look behind this total government jobs figure, and we realize that in the public sector, as a matter of fact, local employment, local jobs are by far and away the biggest slice of the total public sector jobs pie. Local jobs. And so, and that's federal, state, and local, of course, are the three pieces of the total public sector jobs pie. And you can see that federal in aggregate are by far and away the smallest sector of total public employment. What's interesting here, though, and I think is important to understand, is that the rate of decline in total local jobs has actually been slowing rate of decline. So that's a positive thing. That's encouraging. Down 0.7% year over year, compared to down just 0.3% April to May. So the rate of change here is diminishing, which is a good thing because local is the biggest piece of the total public employment pie. Now let's look behind this number, this local number, and what we find is that teaching jobs, or I guess more broadly defined local government education jobs, are by far and away the biggest piece of the total local government jobs pie. And specifically, jobs in education represent 56% of total local jobs. In other words, 56% of this number are in education. And so, and the other piece is local government education. That would be firefighters and all other municipal employees. But again, here what we see is a slowing rate of decline. In other words, the rate of layoffs among teachers is almost flatlined. Again, that's a good thing because it perhaps portends the end of the continuing takeaway in total public sector employment. Now, let's analyze state and local government receipts versus expenditures, because I think this also can tell us whether state and local jobs will stabilize. What you see in the top line are current expenditures, and in the second line, current receipts. And this data is the most recent that we have, and it's through the first quarter of this year. Now, unfortunately, what this chart is telling us is that expenditures are continuing to outstrip receipts at the state and local level in the aggregate. So while current receipts have bottomed and actually ticked up in the most recent quarter, unfortunately there's still a funding gap here, which suggests that there will continue to be pressure at state and local budget levels, which means it'll be real tough for for states and municipalities to start hiring again, and in fact they'll still continue to be under pressure to cut payrolls, at least until these two lines reconverge. Now the other aspect of this chart, going back to the President's comment, that's very important to understand is this aspect. And what we saw is that the American Recovery and Reinvestment Act of 2009 was responsible for this huge surge in revenues received at the state and local level. And you see that. Okay. So in other words, if you look at total receipts up above, a big piece of that, in fact, most of the increase in this period post-recession, or the remaining portion of the recession and post-recession, most of the increase in total current receipts at the state and local level was accounted for by this huge surge in receipts from the federal government via the ARRA. And I think what the President was saying most recently is, well, we probably need another one of these so that states and localities and municipalities can get some help, in his words, to add to payrolls. And that is the crux of the President's argument, at least as I understood it. In other words, what he's saying is, and the legislation that he has proposed to Congress, which Congress has not followed through by adopting, is something akin to the ARRA, which would result in a dramatic increase in funds, once again trickling down to the state and local level, which would in fact help them keep payroll, if not add to payroll once again. The problem is that Congress is pointing out is, well, this cost us at least $1 trillion, and it resulted in a temporary surge in receipts. So yes, it had the effect of adding to payrolls temporarily, but the problem was that when the money runs out, then you're faced with the same budget issue once again. You're probably right back to where you started, having to lay people off, and in the meantime, you've just added $1 trillion to the federal budget debt. And so that, I think, is the political, the crux of the political debate today with respect to the solutions to the joblessness going forward. And then going back, just this final slide, I just wanted to go behind this figure, the total federal payroll, because I think that it's of interest. In other words, I just showed you what's behind the total local jobs pie, but let's look at the total federal jobs pie, and that's what you see in this chart. And the federal jobs pie breaks down into three buckets: the U.S. Postal Service, the Department of Defense, and then everything else. And what you see under everything else is that for about a year, the federal payroll has actually been declining just slightly. That's probably good news. I don't think the President would agree with that, but that would be my opinion, because of the enormous budget constraints that I think we increasingly need to take into consideration. So the total federal payroll has actually been in decline by with a slight negative slope here for about a year. But on the other hand, what the chart also clearly shows is that under the current administration, we've actually added 89,000 net new jobs since the beginning of this administration, or an increase in the total federal payroll of federal payroll ex postal ex DOD of almost 6% under the administration, whereas that number had been flat for the previous decade. And in the meantime, of course, the U.S. Postal Service continues to reduce headcount, and DOD here, you can see most recently, is actually trending a little bit down, having ramped up for, I think, probably obvious reasons, the wars that we've been fighting. And now it looks like DOD headcount is actually starting to roll over just a little bit. Well, those are the observations I wanted to make. Again, in the wake of the President's comment that the private sector is doing just fine, I think it is important to understand exactly the jobs figures that he's perhaps referring to. And I guess in conclusion, I'd say that, well, the president, there was actually a lot of truth in what the president said, but I think politically he probably hurt himself by saying it the way he said it. If I were president, I would talk specifically with the charts and the data at hand so that people really understood the point I was making, because I think this one was really misinterpreted in lots of different respects.
So Fritz, let me understand. Is it fair to judge the success of the stimulus, the $700 million stimulus package, the American Recovery and Reinvestment Act of 2009, by the number of jobs that were created in state and local payrolls? Because that seems to be what you were alluding to in saying that we added $1 trillion to the federal debt and the results, the benefits were temporary.
It's a great question, Andy. As I understood the original design of the ARRA, it was to funnel an enormous amount of cash into so-called shovel-ready projects. In other words, stimulate construction. And what in fact happened is that there weren't enough, there were virtually no shovel-ready projects on which that governments at all levels could spend anywhere close to that amount of cash. And so what happened was, and what you can see in this chart so clearly, is the cash ended up getting funneled to states and municipalities, and they in turn spent it on lots of things other than shovel-ready construction projects. Now, the result of that was, in many cases, what you can see in this chart is that total local payrolls were sustained. Or in this chart, total teaching jobs actually were sustained at a relatively high level, even though we were in the midst of a recession. And tax revenues from all other sources had fallen off or collapsed. But they were those tax revenues were then more than offset by federal grants and aid, which stemmed from the ARRA. And so your question was whether we could judge it by the number of jobs created. I guess you could say, well, the stimulus was successful in the short term by at least allowing states and municipalities not to embark on substantial headcount reduction as long as they were receiving those federal grants and aid. But the problem is that cash had to run out, and in fact it did run out. And so what you can see here is as federal grants and aid rolled over, so did total current receipts at the state and local level, and that resulted in the dramatic headcount reduction that you have seen at the local level in particular, but also at the state level, and particularly pronounced among teachers or those in education, because teaching jobs are 56% of total local government jobs. The stimulus, I guess, could be determined to have been successful but it was a flash in the pan. And because the cash ran out, states and municipalities also now find themselves in a budget crunch, and they're right back to where they started in terms of having to lay people off. So the stimulus in the longer term, I'd say, was not successful because those were not sustainable jobs that were at least held on to. And at this point, the federal government then, as a result of the stimulus program, is $1 trillion further in debt, and we have really nothing to show for it several years after the fact in terms of total employment.
Wow, so the Keynesians are wrong.
The president's economic advisors at the time, and this was Christina Romer, were making the case that there was a so-called multiplier effect. If you spend $800 billion, you're going to stimulate the economy by some multiple of $800 billion. It turns out to not have been the case, and in fact a lot of economists think probably there's a negative multiplier, or at least there is no multiplier. So, you know, if having a multiplier is your definition of a Keynesian success, I think the answer, and I think the evidence of this most recent attempt to stimulate the economy with federal spending was that there was no multiplier. And the problem is you ended up by increasing the total debt by a material amount such that that mountain of debt is really of concern to financial markets. In the current administration, the numbers clearly show that we've gone from $5 trillion to $10 trillion in total debt outstanding just in the last 4 years.